Welcome to the Deep Dive. We're here to pull out the really crucial stuff from the sources you need to know, quickly and without getting bogged down.
Exactly.
Today, we are diving headfirst into management accounting. Think of it as getting the keys to the financial kingdom of a business. All the essentials, none of the fluff.
That's a good way to put it. Our mission here is really to light up those core ideas in management accounting and show you how they actually work in the real world, shaping big decisions, managing costs, and, well, making a business succeed.
And we're pulling this from cost accounting, a managerial emphasis, right? Focusing on the key bits.
Precisely, the concepts that genuinely make a difference.
Okay, so management accounting sounds a bit dry, maybe.
Yeah.
Like something just for the finance folks.
Huh. Well, it might seem that way initially.
But here's the thing I'm starting to get. Whether you're building cars, running a restaurant, or designing clothes, you have to understand where the money's going, right? Costs and revenues. That's how you stay in control.
Absolutely fundamental. And it's way more than just, keeping score after the fact. Management accounting is like the internal GPS for a business. It guides all those internal decisions, working alongside the financial accounting that looks outward.
Okay, internal GPS. I like that.
And what's really interesting now is its role in sustainability. That's a big shift. Chapter 14 in our source really digs into how these accounting tools are being used now to measure environmental and social performance, too.
Sustainability.
Yeah.
Really? So companies are actually using accounting to look beyond just profit.
They are, increasingly so. Modern management accounting gives them the frameworks to assess the broader ripple effects of what they do. And if you connect that to the big picture strategy, you can see how vital that kind of information becomes for building a business that lasts, one that's resilient.
Okay, which leads us straight into strategy.
Yeah.
How does this management accounting stuff actually shape those big high-level choices? The book mentions examples like Parker Hannifin and David Jones.
Right. Good examples. They aren't always the cheapest, are they? But they do well because they offer something distinct, something customers value enough to pay a bit more for.
So it's about justifying a premium price.
Exactly. Or, on the flip side, achieving a real cost advantage. Management accountants provide that critical data. Are we competing on cost being more efficient than everyone else? Or are we competing on differentiation, offering that unique value?
So it helps define your battlefield, basically.
Precisely. And this whole idea of proactively using cost information to tackle strategic issues, that's what we call strategic cost management. Sometimes the smartest move isn't cutting costs, but actually investing more in certain areas to build that long-term edge.
Okay, so digging deep into your costs isn't just about saving money. It's about carving out your place in the market. Got it. Now, the book talks about a value chain. Can you break that down for us?
Sure. Think of the value chain as the whole sequence of activities a business does. Everything from the initial idea and design through production, marketing, getting it to the customer, and even the support afterwards.
The whole life cycle.
Yeah, basically. It's like a chain linking every single step where the business adds value for the customer. R&D to after-sales service, the whole 9 yards.
Okay, the entire journey. And the book says customers have expectations along this journey. These key success factors. What are those, typically?
Right. These are the things customers really care about when they're choosing who to buy from. The source doesn't list them all right here, but you can imagine, right? Things like quality, how fast they deliver, innovation, customer service.
The basics you have to get right.
Exactly. Later on, it gives examples like airlines needing to be on time or certain manufacturers needing to be the absolute lowest cost. It's about focusing on what matters most to your specific customers.
Makes total sense. You've got to deliver on what they prioritize. Now, managing all this, is there a standard playbook? The outline mentioned a 5-step decision-making process.
Well, yeah, that's a cornerstone. It's a really logical framework you can apply to pretty much any business decision, big or small. Later chapters use a newspaper example, the Daily News, to show it in action. But the steps are basically 1. Identify the actual problem. 2. Gather the relevant info. 3. Map out your options and what might happen. 4. Pick the best path. And 5. Crucially, implement it, track how it goes, and learn from it.
Seems straightforward, but where do companies usually mess up?
Good question. Often it's right at the start, not defining the real problem correctly, or maybe not rigorously thinking through the consequences of each option. Step 3 can be tricky.
Interesting. So it's not just about the numbers then. What else does a good management accountant need besides being, a whiz with spreadsheets.
That's a great point. Technical skills are table stakes, obviously. But the source really stresses the people side, too. Teamwork is huge.
Really?
Absolutely. Plus, having a broad grasp of the whole business, not just the finances. And interestingly, empathy, understanding different viewpoints across the company. And building trust, of course.
Empathy. You don't often hear that linked with finance.
But it's vital. How else can you understand how a financial decision might impact, say, the production floor or the sales team? It's about collaboration. And the book also hits hard on fact-based analysis and critical judgment, being able to question assumptions, challenge things constructively. It's all about getting to better decisions.
Right, bringing insight and a healthy dose of skepticism. Okay, let's get down to brass tacks. Costs. The outline mentions cost, concepts, and behavior. First big distinction. Variable versus fixed costs.
Okay, variable costs. These are costs that change in total directly in line with how much you produce or sell. The book uses tires for VE Commodores as an example. Make more cars, you spend more on tires, right? Pretty straightforward.
Got it. More activity, more cost.
Exactly. Fixed costs, though, are different. They stay the same in total over a certain period, even if your activity level bounces around. Think of the supervisor's salary for that Commodore assembly line. Maybe it's $2 million a year, whether they make 10,000 cars or 50,000. The total cost stays fixed.
Okay, variable flexes, fixed stays put, in total. But the book says be careful with fixed cost, always look at the total. Why?
Because the fixed cost per unit changes depending on volume. If that $2 million supervisor cost is spread over more cars, the cost per car goes down. But the total amount the company is committed to paying hasn't changed.
Ah, I see.
If you just look at the per unit fixed cost, you can get tricked into making bad decisions because that number moves around with volume. The total is the anchor.
Okay, focus on the total fixed cost. Now, direct manufacturing labor and indirect manufacturing costs. How do they fit in?
Right. Direct manufacturing labor is the pay for the workers physically making the product, the people on the assembly line, for instance. You can trace their time pretty directly to the units they work on.
Hands-on work.
Exactly. Indirect manufacturing costs, which people often call manufacturing overhead or factory overhead, that's everything else needed for production, but not easily traced to specific units.
Like what?
Oh, things like factory supplies, the maintenance crew's wages, the rent on the factory building, insurance, the depreciation on the factory machines, all that stuff. Necessary, but indirect.
Got it. One's direct, the other's all the factory support costs.
Yeah.
Now, this flow of manufacturing costs sounds like tracking where the money goes in the factory.
That's exactly it. Costs follow a path. They start in work-in-process inventory that's for goods currently being made.
Okay.
Once the goods are finished, their costs move over to become cost of goods manufactured.
Right.
And then finally, when you sell those finished goods, the cost moves one last time to cost of goods sold, which hits your income statement as an expense. The book has some diagrams, figures 2.7 and 2.9, showing this flow visually with T accounts.
Like a cost pipeline.
Okay.
What about inventoriable costs versus period costs?
Good distinction. Inventoriable costs are basically your manufacturing costs, direct materials, direct labor, and that manufacturing overhead we just talked about. They're treated as assets, part of inventory on the balance sheet until the product is sold.
Okay, so it's on the balance sheet first.
Right. Period costs are everything else that's not production related. Think selling expenses, administrative salaries, marketing costs. These get expensed on the income statement in the period they happen. They don't go into inventory. Figure 210 shows this for a retailer.
Got it. One waits for the sale, the other hits the books right away. Now, a cost driver. What's that and why does it matter?
A cost driver is basically the root cause of a cost. It's an activity that has a direct cause and effect link with how much a particular cost object costs.
Example.
Sure. Like the number of hours a machine runs could be a cost driver for electricity costs or maintenance costs. The more it runs, the higher those costs are likely to be. Finding the right cost drivers is key for managing costs effectively.
Okay, finding the thing that actually makes the cost go up or down. And the relevant range, what's that about?
The relevant range is the normal range of activity or volume where your assumptions about cost behavior actually hold true. Well, like that fixed cost for the supervisor. It might be fixed between, say, 10,000 and 50,000 cars. But if production suddenly jumped to 100,000 cars, maybe you'd need a second supervisor, right? So the total fixed cost would jump up. The relevant range is that 10,000 to 50,000 band where the original assumption holds.
Ah, so cost behavior isn't always perfectly linear forever. There are limits. And the book warns about interpreting unit costs. What's the danger?
Yeah, we touched on this with fixed costs. Unit costs blend variable and fixed costs together. Since the fixed part per unit changes with volume, the total unit cost isn't stable.
Right.
Using a unit cost calculated at one volume level to predict costs at a different volume level can be really misleading. You really need to understand the underlying total variable and total fixed costs separately.
Don't get fooled by the average. Understand the components. Okay, lastly here, manufacturing versus retail versus service companies and inventory. What's the difference?
It's mainly about what kind of inventory they hold, if any. Manufacturers have three types: raw materials waiting to be used, work in process goods being made, and finished goods ready to sell.
Okay.
Retailers, they mostly just buy finished goods and sell them, so they mainly just have finished goods inventory.
Makes sense.
And service companies like a law firm or a consultancy usually have little or no physical inventory at all. Their product is intangible, the service itself.
Right, depends on if they make stuff, sell stuff, or do stuff.
Hmm.
Okay, let's shift to estimating cost functions. Sounds a bit like forecasting.
It is, exactly. It's about figuring out how costs behave, how they change as activity levels change. And the book really hammers home the cause and effect criterion for choosing cost drivers,
Right.
meaning there has to be a logical economic reason why that activity actually causes the cost to change. You can't just pick two things that happen to move together by coincidence. There needs to be a plausible link.
Okay, no spurious correlations. And what about time series versus cross-sectional data for this analysis?
Two different ways to slice the data. Time series looks at one company or entity over multiple time periods, like tracking our factory's monthly maintenance costs and machine hours over the last 2 years.
Okay, one subject over time.
Yep. Cross-sectional data looks at multiple different entities at the same point in time. For example, looking at the loan processing costs and number of loans processed at, say, 50 different bank branches in March.
Comparing different subjects at one time. Got it. The outline mentions an elegant rugs example. What's the story there?
Ah, elegant rugs. Good case. They were trying to predict their indirect manufacturing labor costs. They looked at using machine hours or direct manufacturing labor hours as the driver. Their analysis showed machine hours was a much better predictor, a stronger cause and effect link. But the real kicker is the what if. What if they'd chosen the wrong driver, direct labor hours?
What would have happened?
Well, they were thinking about introducing a new carpet style. If they used the wrong driver, they might have underestimated the true cost of making that new style, thought it looked more profitable than it was, and made a bad strategic decision to launch it.
Wow. So a bad cost driver can lead to bad strategy.
Ouch. Okay, the outline also lists some technical sounding assumptions: linearity, constant variance, independence of residuals. Can we simplify that? What are we checking for?
Yeah, those are statistical checks, mainly for when you use methods like regression analysis. Basically, you're checking if your mathematical model is a decent fit for reality.
How so?
Linearity just assumes the relationship between cost and activity is roughly a straight line within that relevant range we talked about. Constant variance means your predictions aren't getting wildly more inaccurate at higher activity levels. Independence means one prediction error doesn't affect the next one.
So basically, is our cost model reasonably well behaved and predictable?
Exactly. If these assumptions are way off, your cost predictions might not be very reliable. You need to be aware of the limitations. Okay. And how does multiple regression help get a better picture sometimes?
Simple regression uses just one cost driver to predict a cost. But sometimes a cost is really driven by more than one thing, right?
Yeah, sure.
Multiple regression lets you build a model using two or more cost drivers simultaneously. Elegant rugs, again, they found that using both machine hours and the number of production batches together gave them an even more accurate prediction of those indirect labor costs than just using machine hours alone.
So sometimes you need multiple factors to explain what's going on. Makes sense. Okay, let's tackle cost volume profit analysis as CVP. This sounds like a really core tool.
It absolutely is. CVP analysis looks at the relationships between costs, sales volume, selling prices, and ultimately profit. It's super useful for managers thinking about pricing, what products to push, how much they need to sell.
The profitability puzzle.
Exactly. The key pieces are your total fixed costs, your variable cost per unit, and your selling price per unit. The book uses a software example, Brooks Do All software, to lay out these basics.
Okay, fixed costs, variable cost per unit, selling price. Got it. So what's the break-even point? That sounds important.
Very important. It's the point in terms of units sold or sales dollars where your total revenue exactly equals your total costs. You're not making a profit, but you're not making a loss either. You're breaking even.
How do you figure that out?
The simplest way in units is to divide your total fixed costs by your contribution margin per unit.
Contribution margin. What's that?
Key concept. Contribution margin per unit is just your selling price per unit minus your variable cost per unit. It's the amount each unit sold contributes towards covering your fixed costs and then generating profit.
Okay, selling price minus variable cost. That makes sense what's left over per unit. And CVP isn't just about breaking even, is it? The outline mentions target operating profit and sensitivity analysis.
Right. It's much more powerful than just finding break even. You can use it to calculate how many units you need to sell to hit a specific target profit. Just add that target profit to your fixed costs in the numerator of the break even formula.
Okay. Useful for planning.
Definitely. And sensitivity analysis, or what if analysis, is crucial too. It lets you see how your break-even point or target profit changes if your assumptions change, like if your selling price goes up or your variable costs increase or fixed costs change.
Testing different scenarios.
Exactly. And the book also introduces the margin of safety. That's basically the cushion between your actual or expected sales and your break-even point. Tells you how much sales could drop before you start losing money.
A measure of risk.
Yeah.
Okay. What if you have multiple cost drivers? Does the basic CVP still work?
The basic model assumes units sold is the only driver. But yeah, in reality, other things can drive costs too. Like the Brooks example, again, maybe costs depend partly on units sold and partly on the number of customer support calls, for instance.
Right.
In those cases, you need a more sophisticated analysis that incorporates those multiple drivers. The basic CVP is a starting point.
Okay. It can get more complex. The outline also says choosing your cost structure, the mix of variable and fixed costs, is a strategic decision. Why?
Because that mix really affects your company's operating leverage and risk profile.
How so?
Well, think about it. A company with really high fixed costs and low variable costs per unit has a higher break-even point. But once they get past break-even, profits climb really fast because each extra sale contributes a lot. High risk, high reward potential.
Okay.
Conversely, a company with low fixed costs and high variable costs has a lower break-even point, which is safer. But their profits won't grow as dramatically with higher volume. Less risk, potentially less reward.
So it's a fundamental trade-off.
Exactly. It depends on your industry, your certainty about future sales, your risk tolerance. It's a big strategic choice.
Interesting. And lastly, for CVP, sales mix.
Yeah.
That comes up when you sell multiple products.
Yep. If you sell, say, product A and product B, and they have different selling prices and variable costs, meaning different contribution margins, your overall break-even point depends on the proportion you sell of each.
Mix matters.
Totally. If you sell more of the high-margin product, you'll break even sooner than if you sell more of the low-margin one. The Belter Ltd. Example in the book walks through calculating break-even with a specific sales mix.
Okay. Got to factor in the product blend. Right. Let's switch gears to job costing. Sounds like tracking costs for specific, unique projects.
That's the perfect way to think about it. Job costing is for situations where each product or service is distinct. Think custom home building, consulting projects, movie production, making custom machinery.
Low volume, high uniqueness.
Exactly. The goal is to capture all the costs, direct materials used, direct labor time spent, and a fair share of overhead for each individual job.
Okay. The outline mentions actual costing versus normal costing. What's the difference?
Actual costing uses the actual costs incurred for everything, actual material prices, actual labor rates, and the actual overhead costs that happened during the period the job was worked on.
Sounds straightforward.
It is, but figuring out the actual overhead rate per job can be tricky and often delayed until the end of the period. Normal costing is more common in practice. It uses actual costs for direct materials and direct labor, but it applies overhead using a predetermined budgeted overhead rate.
Using an estimate for overhead.
Right. The example of job B01 in the source shows this. You calculate the budgeted rate at the beginning of the year, maybe based on estimated total overhead and estimated total activity, and apply that rate to jobs as they happen. It gives you more timely cost information.
Okay, smoother and faster. But what if that budgeted rate isn't perfect? What if you apply too much or too little overhead compared to what actually happened? The outline talks about proration.
Good question. At the end of the year, you compare the total overhead you applied using the budgeted rate to the total overhead you actually incurred. If there's a difference, and there usually is, it's either underallocated, applied too little, or overallocated, applied too much.
Then what?
If the difference is small, Companies often just close it out directly to cost of goods sold. Easy. But if it's a significant amount, the theoretically better way is to prorate it.
Prorate, meaning spread it out.
Exactly. You spread that under or over allocated amount proportionally across the accounts where the overhead ended up. Work in process inventory, finished goods inventory, and cost of goods sold. This makes the final balances more accurate, reflecting closer to actual costs.
Okay, adjusting the books to match reality. Now, briefly, process costing. The Mahonry Ltd. example. How's that different from job costing?
Process costing is the flip side. It's used for mass production of identical or very similar units that flow continuously through different processes. Think chemicals, oil refining, food processing like canned soup, drinks.
High volume, identical units.
Right. Instead of tracking costs by job, you accumulate costs by department or process for a period. Then you average those total costs over all the identical units produced in that period. The Mahonry Ltd. example uses the weighted average method to show this cost assignment.
So, job costing for unique items, process costing for mass production. Got it. Let's move to activity-based costing, or ABC. Sounds like a more refined way to handle that tricky overhead allocation.
You nailed it. ABC aims for much more accuracy in assigning indirect costs. It does this by first identifying the specific activities that consume resources, things like machine setups, product design, quality inspections, customer service calls.
Okay, breaking down the work.
Then it assigns the cost of those activities to products or services based on how much of each activity they actually use. The idea is that products don't consume costs directly, they consume activities, and activities consume resources.
Tracing the consumption path more carefully.
Precisely. The book points out it's especially useful when overhead is a big chunk of total cost, and when you have a lot of diversity, different products, different customers, different processes that consume resources in very different ways. Think universities, banks like ASB, postal services like Australia Post. ABC gives them much better cost insights.
Right. Complexity and high overhead make it valuable. How does a simple traditional system compare? The outline uses Relands Ltd. as the starting point.
A simple system often just lumps all overhead into one big cost pool, or maybe a few departmental pools. Then it allocates that overhead using a single, often volume-based driver like direct labor hours or machine hours. Relands initially used direct manufacturing labor hours for everything.
One size fits all, basically.
Pretty much. ABC refines that dramatically. You identify lots of specific activities, create cost pools for each, find the best cost driver for each activity pool, like number of setups for the setup activity, calculate a cost rate per activity, and then allocate costs based on actual activity usage.
Multiple smaller buckets instead of one big one makes sense.
Mm-hmm.
What triggers a company to switch from simple costing to ABC? The outline mentions reasons for refining.
Usually three main things push companies towards refinement, like ABC.
Right.
One, increased product diversity. When you have simple products and complex products being costed with the same broad brush, you get distortions. Two, indirect costs become a much bigger proportion of total costs. When overhead is huge, getting it wrong really hurts.
Right.
And three, intense competition. When margins are tight, you absolutely need accurate cost information for pricing, deciding which products to push, and identifying inefficiencies.
Got it. Complexity, cost structure, competition. Now, activity dictionaries and cost drivers in ABC. What are those in practice?
An activity dictionary is just what it sounds like, a list and description of all the key activities the organization performs. For each activity, you then pinpoint the best cost driver, the factor that causes the cost of that activity to fluctuate.
So if we're setting up a machine.
The cost driver might be the number of setups or setup hours. For product design, maybe it's number of parts or design hours. Relands, in the example, develops drivers like square meters for design, setup hours for molding setup, machine hours for operations. It's about finding that specific cause.
Okay, a detailed map of activities and their cost triggers. How does this give a better cost picture? The S3 and CL5 lenses example for Relands.
That's a classic ABC outcome. The simple system at Relands, just using direct labor hours, ended up overcosting the simple S3 lens and undercosting the complex CL5 lens.
Why?
Because the complex CL5 lens used way more of the batch-level activities like setups and product-sustaining activities like complex design work, which weren't captured well by just looking at labor hours. ABC, with its multiple activity drivers, correctly assigned more of those indirect costs to the CL5, revealing it was less profitable than they thought, while the S3 was actually more profitable.
Prevents cross-subsidization. Simple products aren't subsidizing complex ones anymore.
Exactly. That's a huge benefit. It stops you from making bad decisions based on flawed cost data.
And how does this help with pricing and product mix decisions?
Well, once Relands knew the true costs, they could price more intelligently. They realized they could be more competitive on the S3 lens price and still make good money.
Right.
And they could make strategic choices about their product mix. Maybe focusing more marketing effort on the now revealed to be more profitable S3, or finding ways to make the CL5 production more efficient, or even adjusting its price. It gives you the clarity to act strategically.
Better costs lead to better strategy. Makes sense. How does ABC stack up against department costing systems? Is it always better?
Department costing is definitely a step up from using just one single plant-wide overhead rate. It uses separate rates for each production department, but ABC is generally seen as a further refinement.
How so?
While department rates capture cost differences between departments, ABC digs deeper into the specific activities happening within and across departments. It often provides a more accurate, activity-focused view, especially if activities cut across department lines, which they often do. Figure 6-7 shows how a company might blend departmental and ABC ideas.
Okay, ABC is more granular, focused on the work itself. Right, let's connect cost management and capacity management. How do those two relate?
Capacity is basically how much stuff your organization can produce in a given time. Capacity management is about deciding how much capacity to have, how many machines, how big a factory, how many staff.
Oh, yeah.
The link to cost management is huge because capacity costs money, especially fixed costs like rent, depreciation, salaries for permanent staff. If you have a lot of capacity, you're not using idle capacity, you're still paying for it, and that drags down your profitability. Managing capacity well is key to managing costs.
Paying for resources you're not using.
Got it.
Okay, the outline distinguishes practical capacity from master budget capacity utilization. What's that about?
Practical capacity is the maximum output you could realistically achieve, allowing for normal downtime like maintenance, holidays, shift changes. It's what the facility could produce efficiently.
The theoretical but achievable max.
Right. Master budget capacity utilization is the level of capacity you actually plan to use based on your sales forecast for the budget period.
What you expect to use.
Exactly. The difference between practical capacity and master budget utilization is your planned unused capacity. The Micromite example shows how some companies track the cost of this planned unused capacity separately. They might charge the cost of capacity needed for current sales to the sales marketing team, but keep the cost of planned unused capacity separate, maybe as a strategic cost.
Interesting. Separating the cost of current operations from the cost of future potential. Okay, pricing decisions. Where do companies start setting prices?
Two main approaches are often the starting points. Market-based pricing looks outward. What are competitors charging? What are customers willing to pay?
Okay, customer and competitor focused.
Then there's cost-based pricing, which looks inward. What does it cost us to make this? Let's add a markup to get the selling price, usually called cost plus.
Cost plus. Common.
Very. But the source stresses that no matter where you start, you ultimately have to consider the market. You can't just ignore what customers will pay or what competitors are doing, even if you use cost plus initially.
Market reality always bites. Okay. What about target costing? How does that flip things around?
Target costing is really interesting, often used for new product development. It starts with the market. What price will customers realistically pay for this new product? The target price.
Okay, starts with the selling price.
Then the company decides on its required profit margin, target operating profit per unit. Subtract the target profit from the target price, and what's left is the maximum allowable cost to make the product the target cost per unit.
Target price, target profit, target cost.
Exactly. The whole challenge then becomes designing the product and the production process to meet that target cost. It forces cost considerations right into the design phase using tools like value engineering. It's designing the cost out from the start rather than trying to cut costs later.
Proactive cost management right from the drawing board. Cool. Okay, relevant costs for decision making. What makes a cost relevant?
This ties back to that 5-step process again. Relevant information, whether it's a cost or a revenue, has two key characteristics. One, it has to be an expected future cost or revenue. Past costs don't matter.
Future focused.
Two, it has to differ among the alternative choices you're considering. If a cost is going to be the same whether you choose option A or option B, then it's irrelevant to the decision between A and B.
Must happen in the future. A and D be different between choices.
That's the mantra. Sunk costs, money already spent, are always irrelevant because they aren't future costs and they don't differ between future choices. It's all about what changes going forward based on your decision.
Right. Forget the past. Focus on the future differences. The outline uses make or buy decisions.
Hmm.
Matilda Ltd. CD players as an example. What's relevant there?
In make or buy, you compare the future costs you'll incur if you make the component yourself versus the future costs if you buy it from outside.
Such as?
Well, if you make it, relevant costs might include the future direct materials, direct labor, and any variable overhead. Maybe even some avoidable fixed costs if making it requires extra supervision or machine time you wouldn't otherwise need. If you buy it, the relevant cost is primarily the purchase price from the supplier.
So you compare the avoidable internal costs to the external purchase price.
Exactly. And the Matilda example stresses looking at the total relevant cost for the volume you need, not just relying on maybe misleading per unit costs that might include irrelevant allocated fixed costs.
Okay, total future costs that differ. What about environmental opportunities as a qualitative factors? How do they fit in?
Decisions aren't always just about the numbers. Qualitative factors matter too, and environmental impact is a big one now. The examples given Coca-Cola Amatil using solar, Top Ride City recycling show that sometimes choices with environmental benefits can also have positive economic outcomes, like lower energy bills or better community relations.
So looking beyond the spreadsheet.
Yes, you need to weigh these qualitative aspects alongside the quantitative financial analysis. They can tip the balance.
Got it. And opportunity costs. How do they work?
An opportunity cost is the benefit you give up by choosing one option over another. It's the value of the next best alternative you didn't take.
The road not traveled.
Kind of. The Matilda DVD player example shows this. If Matilda decides to make the CD players in-house, they use up factory capacity. If they had chosen to buy the CD players instead, that freed up capacity could have been used to make profitable DVD players. The potential profit from those DVD players is the opportunity cost of making the CD players.
So the potential profit you miss out on by using resources one way instead of another. That's tricky, but important.
Crucial. It's often hidden, but very real.
Okay. What about constraining resources?
Yeah.
Power Recreation's engine example. How do you decide what to make when you can't make everything you want?
Right. Often companies have a bottleneck, limited machine hours, limited skilled labor, limited materials. That's a constraining resource.
The weakest link.
Exactly. When you have a constraint, you can't just prioritize the product with the highest profit per unit. You need to prioritize the product that gives you the highest contribution margin per unit of the constraining resource.
Per unit of the bottleneck.
Yes. If machine time is your bottleneck, you want to make the product that earns you the most profit for every precious machine hour used. Power Recreation needs to figure out which engine, quad bike, or boat yields more profit per machine hour and make that one first.
Maximize profit from your most limited factor. Smart. Now, equipment replacement decisions. Why is the carrying amount, book value of the old equipment irrelevant? Jones Ltd. example.
Because the book value is a sunk cost. It reflects money spent in the past based on past depreciation estimates. It tells you nothing about the future cash flows of keeping the old machine versus buying a new one.
It's history.
Exactly. The relevant things are the future operating costs of the old machine compared to the new one, maybe the disposal value of the old machine and the purchase price of the new one, things that will happen in the future and will be different depending on your choice. Jones Ltd. illustrates this. Ignore the book value, focus on future cash flows.
Got it. Sunk costs, sink decisions if you let them. What about outsourcing and special order decisions?
Right.
Relevant costs there. Scoot Ltd. and the pen maker examples.
Similar logic applies. Outsourcing, like make or buy, compare the internal avoidable cost of doing the activity yourself versus the external cost of paying someone else, like Scoot Ltd. Deciding about motor scooters. Don't forget potential opportunity costs if outsourcing frees up resources.
Okay, and special orders.
For a special order, usually a one-time deal, maybe at a lower price, you look at the incremental revenue from the order versus the incremental costs of filling it.
Incremental meaning just the extra stuff.
Yes. What extra materials, extra labor, extra variable overhead will this order cause? Maybe even some extra fixed costs if you have to run an extra shift. As long as the special price covers all those incremental costs, accepting the order adds to your overall profit, even if the price is below your normal selling price. The pen maker example shows this incremental analysis, but you also have to consider if it impacts your regular sales.
Right, look only at the additional costs and revenues for that specific order. Okay, let's talk customer profitability analysis. Why bother analyzing profit customer by customer? Aren't sales just sales?
Oh, definitely not. It's often surprising how profitability varies across customers. Some customers might buy high-margin products, order efficiently, pay on time, and require little support. Others might do the opposite.
The squeaky wheels.
Yeah. Haha. Sometimes. Understanding these differences, both in the revenue they generate and, crucially, the costs required to serve them, lets companies focus resources effectively. You want to nurture your most profitable customers and figure out how to make less profitable ones better, or maybe even stop serving the ones who consistently lose you money.
Know who your best customers really are. How does the activity-based cost hierarchy apply here?
It's applying ABC principles to customer costs. You categorize the costs of serving customers based on what drives them.
Like,
You might have customer unit level costs, cost per item shipped to them, customer batch level costs, cost per order processed for them, customer sustaining costs, cost of having them as a customer like sales visits, and maybe even distribution channel costs, cost of serving them through retail versus online. It helps pinpoint why some customers cost more than others.
breaking down the cost to serve. Okay, what's this whale curve of cumulative profitability? Crystal distribution example.
The whale curve is a graph. You rank your customers from most profitable to least profitable and then plot their cumulative profit. It almost always looks like a whale's back.
How so?
You typically see a steep rise at the beginning, your top 20% or so of customers generating maybe 150% or more of your total profit. Then it flattens out in the middle with customers who are roughly break even. And then crucially, it often slopes down at the end, meaning your least profitable customers are actually dragging your overall profits down. The crystal distribution example shows this classic pattern.
Wow. So a few customers make most of the money, and some actually cost you money.
Mm.
That's powerful. How do you calculate this customer-level operating profit?
Conceptually, it's simple. For each customer, you take all the revenue they generated in a period and subtract all the costs specifically associated with serving them during that period, using that cost hierarchy we just talked about. It's like a mini P&L for each customer.
Customer income statement. What actions might a company take based on this?
Lots of things, maybe differential pricing or service levels, maybe trying to sell higher margin products to the less profitable ones, maybe finding ways to reduce the cost to serve for certain segments, encouraging online ordering, for example.
Oh, yeah.
Or in some cases, if a customer segment is consistently unprofitable despite efforts to fix it, you might make the tough decision to fire those customers. It's about strategically managing your customer portfolio.
Right. Investing resources where they generate the best return.
Yeah.
Okay, shifting to budgeting and responsibility accounting. Budgets seem pretty fundamental.
Absolutely essential. The master budget is the big financial plan for the whole organization, usually for a year. It rolls up lots of smaller budgets: sales budget, production budget, materials budget, labor budget, overhead budget, cash budget, name it. Schedules 1, 7, 8, and Figure 10.3 in the book show parts of this interconnected web. It's the roadmap.
The financial blueprint. What's budgetary slack or padding? Why is that bad?
Budgetary slack is when managers deliberately lowball their revenue forecasts or inflate their cost estimates when setting the budget.
Why would they do that?
To make it easier to hit their targets, it creates a cushion. But it's generally bad because it leads to resources not being allocated efficiently, planning becomes inaccurate, and it hides the organization's true potential. It undermines the whole point of budgeting.
Making the budget less useful. Okay. Budgets are used for planning and performance evaluation. How do you balance those two? Can be tricky, right?
It really can be. If the budget is seen purely as a rigid stick to beat people with for performance reviews, managers will naturally build in slack or focus only on short-term actions to meet the numbers, even if it hurts the company long-term.
So how do you avoid that?
Many companies try to use budgets more as planning guides and benchmarks, but evaluate performance using a broader set of measures, considering contexts like the economy or competitor actions. Others use budgets for both, but foster a culture where realistic targets and continuous improvement are valued over just hitting a potentially padded number. It's about using it intelligently, not mechanically.
Use it as a tool, not a weapon. Got it. What are responsibility centers and responsibility accounting?
A responsibility center is just a part of the organization, a department, a division, a product line, where a specific manager is held accountable for a particular set of activities and results.
Types.
There are 4 main types: cost centers, manager responsible for costs; revenue centers responsible for revenues, profit centers responsible for both revenues and costs, and investment centers responsible for profits and the assets used to generate those profits.
Okay.
Responsibility accounting is the system that tracks the plans, budgets, and actual results for each of these centers. It's about assigning clear ownership and accountability.
Matching results to the person in charge. What's the deal with controllable versus non-controllable costs in performance reports?
Controllable costs are those that the manager of that specific responsibility center can significantly influence within a given period. Non-controllable costs are ones they really can't affect much, like maybe the share of corporate headquarters rent allocated to their department.
So focus evaluation on what they can control.
Ideally, yes, it's fair. However, the book notes that often reports show all costs associated with a center, controllable or not, because the manager might have the best knowledge about those costs, even if they can't fully control them. It's about getting information to the right person, too.
Information for oversight, even without full control. Okay. The cash budget is different from the operating profit budget. Why the DCEP focus on cash?
Hugely important distinction. The operating profit budget looks at revenues earned and expenses incurred the accrual basis showing profitability. The cash budget tracks actual cash coming in and going out.
Cash flow.
Exactly. A company can be very profitable on paper but run out of cash if customers don't pay quickly or if they have big investments to make. Profit doesn't equal cash in the bank. Figure 10.6 shows a typical cash budget, absolutely vital for survival.
Can't pay bills with profit on paper. Got it. What's Kaizen budgeting?
Kaizen is the Japanese philosophy of continuous improvement. Kaizen budgeting builds that idea right into the budget process. Instead of setting a static cost target for the year, it budgets for planned, ongoing improvements and cost reductions throughout the year. It assumes things will keep getting incrementally better.
A budget that expects continuous improvement.
Interesting. Okay. Flexible budgets and variance analysis. How is a flexible budget different from the static one we just discussed?
A static budget is set for one specific planned level of activity and doesn't change. A flexible budget is cleverer. It's designed so you can adjust it after the fact to show what costs and revenues should have been for the actual level of activity you achieved.
Adjusts to reality.
Exactly. Table 11-3 shows this. It lets you make a true apples-to-apples comparison. Compare your actual results to what the budget says you should have achieved for the actual work done. Much better for performance evaluation than comparing actual results at one volume to a static budget set for a different volume.
Apples to apples. Makes sense. So what are flexible budget variances? That's simply the difference between your actual result, say, actual materials cost, and the amount the flexible budget says you should have spent on materials for the actual output you produced. It highlights deviations from the plan after adjusting for volume changes.
Isolates performance issues, not volume issues.
Mm-hmm.
Okay. The outline uses WebLTD to show direct materials, variances, price, and efficiency. How do those work?
Two key breakdowns for materials. The price variance asks, did we pay more or less for our materials than we budgeted? It's calculated as actual price, standard price, times the actual quantity purchased.
Okay. Variance due to price paid.
The efficiency variance, sometimes called quantity variance, asks, did we use more or less material in production than we should have for the actual output we got? It's actual quantity used, standard quantity allowed for actual output, times the standard price.
Variance due to quantity used.
Exactly. Figure 11-1 lays this out clearly. One focuses on purchasing effectiveness, the other on production efficiency.
Got it. Now, the outline stresses using variances for both performance evaluation and organizational learning, cautioning against overdoing the evaluation part. Why?
Because if it's all about blame and rewards based on variances, people get defensive. They might game the system, build in slack, or hide problems to avoid bad variances.
Right.
The real value comes when you also use variances to ask why. Why did we pay more? Why did we use more material? Understanding the root causes helps the organization learn and improve processes. The Nissan plant example shows using real-time, non-financial data for this kind of ongoing learning. It's about improvement, not just judgment.
Learn from mistakes, don't just punish them. How does variance analysis work with ABC?
You can apply the same logic, but at a more detailed level. For each activity cost pool in your ABC system, you can calculate variances. For instance, for the machine setup activity, you could have a spending variance. Did the resources for setups cost more or less than budgeted? And an efficiency variance. Did we perform more or fewer setups than expected for the actual production level?
So drilling down into activity performance.
Exactly. And knowing if an activity is unit level, batch level, etc., helps interpret those variances correctly.
Okay. What about sales mix and sales quantity variances? Spring LTD example, used when you sell multiple products.
Yes, these break down the difference between budgeted and actual overall profit or contribution margin when you have a mix of products. The sales quantity variance looks at the impact of selling a different total number of units than budgeted, assuming the mix stayed the same.
Impact of total volume.
The sales mix variance looks at the impact of selling a different proportion of products than budgeted, even if the total quantity was as planned. Did we sell more high margin or low margin products than expected?
Yeah.
Figure 11 to 5 shows the calculation.
Impact of the product blend. Got it. And fixed overhead variances. Spending and production volume, web LTD again. How are these different?
Okay, fixed overhead. The spending variance is pretty simple. It's just the difference between actual total fixed overhead costs and the budgeted total fixed overhead costs. Did we spend more or less than planned on things like rent, salaries, etc.?
Actual versus budgeted spending.
The production volume variance is unique to fixed overhead. It arises because we typically allocate fixed overhead to products using a predetermined rate based on some expected denominator activity level. If our actual activity level is different from that denominator level used to set the rate, we'll have a variance.
So it's about actual volume versus the planned volume used for the rate.
Exactly. It's often interpreted as the cost of capacity utilization, either having idle capacity, unfavorable variance if actual volume is less than denominator, or utilizing capacity better than planned, favorable variance if actual volume is more. It's not really about spending control, more about capacity usage measurement. Web LTD shows this.
Less about spending, more about using capacity.
Okay.
And what happens to all these overhead variances at year end? Write-off or proration?
Same basic idea as with normal costing overhead differences. If the total net overhead variance, variable plus fixed, is small, immaterial, companies usually just write it off to cost of goods sold. Quick and easy.
And if it's large?
If it's material, it should ideally be prorated, spread proportionally across the accounts where that overhead ended up. Work in process, finished goods, and cost of goods sold. This makes the financial statements reflect actual costs more accurately. Some companies might analyze the variances further and write off the inefficiency parts, but prorate the rest.
Adjusting the books for accuracy. Got it. Let's talk support department cost allocation. What are support departments and why allocate their costs?
Support departments are the internal functions that don't directly make the product, but provide essential services to those that do, the operating departments. Think IT, HR, accounting, building maintenance.
The backbone functions.
Right. Their costs are indirect to the final product, but the operating departments couldn't function without them. Allocating their costs to the operating departments gives a fuller picture of what it truly costs to run those operating departments and, ultimately, make the products. It helps with pricing, performance evaluation, understanding profitability.
Sharing the burden of those essential indirect costs. Okay, 3 methods mentioned. Direct, step-down, reciprocal. Figure 13-2 shows the direct method. Briefly, what's the difference?
The direct method is the simplest. It just allocates each support department's costs straight to the operating departments, completely ignoring any services support departments provide to each other. Figure 13-2 shows this very straightforward.
Okay, ignores internal support services.
The step-down method is a bit more sophisticated. It allocates support costs sequentially. You start with one support department, maybe the one serving the most other support departments, allocate its costs to all other departments, support and operating. Then you move to the next support department and allocate its costs, including any it received in the first step, to the remaining departments. Once a department's costs are allocated, it doesn't receive any back.
A one-way street allocation.
Kind of. The reciprocal method is the most accurate theoretically, because it fully recognizes that support departments provide services to each other. IT helps HR, HR helps IT, etc. It usually requires solving simultaneous equations or using computer iterations to figure out the true interdepartmental costs before allocating them out to operating departments. More complex, but more precise.
Right, a spectrum from simple to complex, depending on how much inter-service you want to recognize. What about allocating revenue for bundled products? Wordmaster, Finance Master example, using the standalone method.
Yeah, sometimes companies sell a package deal, 2 or more products or services bundled together for one price, maybe less than buying them separately.
Like software suites.
Exactly. For accounting reasons, like recognizing revenue properly over time or valuing inventory, you often need to allocate that total bundle revenue back to the individual items in the bundle. The standalone method is common. You look at what each item would sell for on its own.
Their individual prices.
Right. You use the ratio of those standalone prices to allocate the bundle revenue. So if Wordmaster sells for $100 alone and Finance Master for $180, and the bundle is $280, you'd allocate the $280 based on the 100.180 ratio. The selling prices method reflects relative value.
Allocating based on relative standalone value. Okay, let's pivot to sustainability and environmental management accounting, EMA. Definitely a hot topic.
Huge. The book really emphasizes this is becoming mainstream, citing big names like National Australia Bank, BHP Billiton, Toyota, Qantas committing to sustainability. It links systems thinking, seeing the interconnectedness to that five-step decision model when tackling environmental and social issues.
Thinking bigger picture, beyond just the company walls. The outline mentions internalizing externalities like an emissions trading scheme. What does that mean?
An externality is a cost or benefit caused by a producer that is not financially incurred or received by that producer. Pollution is a classic negative externality. The company doesn't pay for the environmental damage directly.
Society pays.
Right. Internalizing the externality means making the company bear that cost. An emissions trading scheme is one way companies have to buy permits to emit greenhouse gases, effectively putting a price on pollution and forcing them to factor that cost into their decisions.
Making polluters pay. Got it. What's the Global Reporting Initiative, GRI?
The GRI provides the most widely used framework globally for organizations to report on their sustainability performance, economic, environmental, and social impacts. It gives principles for what makes a good report, like balance, accuracy, clarity tables 14.2 and 14.3 show these, and standard disclosures. It aims for consistency and comparability so stakeholders can trust the information.
The standard for sustainability reporting.
Okay.
And environmental management accounting, EMA itself. How does it fit into an environmental management system, EMS? Blue Scope Steel example.
EMA focuses specifically on identifying, collecting, and analyzing environmental information, both physical data, like tons of waste, and monetary data, like pollution control costs, to support internal decision-making.
Accounting for environmental impacts.
Yes, an EMS is the broader overall system a company uses to manage its environmental responsibilities and performance systematically. EMA is a key tool within that broader EMS framework. Figure 14.3 shows how EMA feeds into BlueScope Steel's EMS. It provides the data needed to manage effectively.
EMA provides the data for the EMS. Is there a real business case for corporate sustainability, or is it mostly just good PR?
Oh, there's definitely a strong business case emerging. It's not just ethics. Sustainability initiatives can lead to real economic benefits, cost savings from energy efficiency, attracting investment, appealing to green consumers, enhancing brand reputation, attracting and retaining talent, reducing risks.
Tangible benefits.
Absolutely. Better environmental and social performance can often feed directly into better financial performance. It's increasingly seen as smart business.
Good to hear. What are life cycle analysis, LCA, and life cycle costing, LCC?
They both look at a product or service over its entire life, from raw materials to disposal. LCA focuses on assessing the environmental impacts at each stage: energy use, emissions, waste generated.
Environmental footprint from start to finish.
LCC focuses on tracking all the costs incurred across that entire life cycle, including costs for the producer, supplier, customer, like usage costs, and disposal costs.
Total cost of ownership plus more.
Exactly. One environmental, one financial, both looking at the whole lifespan.
Okay. And cradle to grave versus cradle to cradle.
Cradle to grave is the traditional linear model. Extract resources, make product, use product, throw product away, grave.
Make waste.
Right. Cradle to cradle is a circular economy concept. Products are designed from the start so that at the end of their useful life, their materials can be safely returned to the soil or endlessly recycled into new high-quality products. It closes the loop, eliminating the concept of waste.
Designing for regeneration, not disposal. Very different mindset. Okay. Balanced scorecard and strategic profitability analyses. The balanced scorecard sounds like a broader view of success.
It is. It's a performance management framework that looks beyond just financial results. It includes measures across 4 key perspectives, typically. Financial, how do we look to shareholders? Customer, how do customers see us? Internal business process, what must we excel at? And learning and growth, how can we continue to improve and create value?
A multi-dimensional view.
Yes. The Infosys example shows how it helps translate high-level strategy into a linked set of measurable objectives and metrics across these areas. It keeps the focus balanced.
How does it link strategy to measures?
For each strategic objective within a perspective, like Improve customer satisfaction in the customer perspective. You define specific metrics you'll track, like customer survey scores or repeat purchase rate. It creates a cause and effect map showing how achieving objectives in learning and growth should lead to better internal processes, which leads to happier customers, which ultimately drives better financial results.
A chain reaction towards the strategy. Got it. What about growth, price recovery, and productivity components in strategic profitability analysis? Tip set example, what do they tell you?
This analysis breaks down the change in operating profit from one period to the next into three main drivers. The growth component measures how much profit changed simply due to selling more or fewer units.
Impact of volume change.
The price recovery component measures the profit impact of changes in selling prices and changes in input prices, materials, labor costs. Did selling price increases offset input cost increases?
Impact of price changes, output and input.
And the productivity component measures how much profit changed due to using inputs more or less efficiently. Did we make the same output with fewer inputs, or vice versa? Table 15.2 shows this breakdown for chipset. It helps understand why profit changed. Was it volume, pricing power, or efficiency gains?
Pinpointing the source of profit change. Useful. Briefly. Quality, time, and theory of constraints, all critical operations areas.
Definitely. The book covers costs of quality prevention, appraisal, internal failure, external failure costs, Kanga copy example. It looks at time as a competitive weapon delivery speed, response time, new product development time. And the theory of constraints focuses on identifying and managing your biggest bottleneck to improve overall system throughput. All about operational excellence.
Minimize defects, be fast, manage bottlenecks. Got it. Inventory management, always a balancing act.
It is. The book discusses the classic economic order quantity EOQ model, which tries to find the optimal order size by balancing ordering costs against carrying costs.
Finding the sweet spot for order size.
But then it contrasts that with just-in-time JIT system.
Where?
JIT aims to minimize inventory radically, getting materials and producing goods only as needed. The goals are slashing carrying costs, improving quality by exposing problems faster, and boosting responsiveness.
Lean philosophy. Minimize waste, including inventory waste. What are back flush costing and lean accounting used in JIT?
Yes, they're simplified accounting approaches often used with JIT. Because inventory levels are so low in JIT, you can simplify the accounting. Backflush costing delays some of the usual accounting entries until goods are finished or sold, flushing the cost through at the end. Lean accounting aligns performance measures and reporting with lean principles, focusing on value streams and waste elimination rather than traditional variance analysis.
Simplifying accounting for simplified operations.
Well,
Okay, capital budgeting is big investment decisions.
exactly. Deciding on major long-term projects, new factories, major equipment, new product lines, the book covers key methods: net present value, NPV, internal rate of return, IRR, payback period, and accounting rate of return, AARR. Topspin's carbon fiber project is the example, with NPV shown in figures 18:2 and 18:3.
These are ways to evaluate big projects.
Right. NPV is generally preferred theoretically, as it discounts future cash flows back to their present value, accounting for the time value of money. IRR finds the project's effective rate of return. Payback is simple: how fast do we get our money back? AARR looks at accounting profit relative to investment.
NPV sounds most sophisticated. The key is focusing on expected future cash flows.
Absolutely critical. Capital budgeting is all about the future. You need to estimate the future cash inflows and outflows the project will generate. Past costs, sunk costs, are irrelevant. It's entirely forward-looking. Are the expected future cash benefits discounted to today greater than the initial investment? That's the core question NPV answers.
Look forward, not back. Discount the future. Okay, finally, management control systems and performance measurement. How organizations keep things on track.
Right. A management control system is the whole set of tools and processes managers use to ensure employees' actions align with the organization's goals. This includes organizational structure, like decentralization, spreading decision-making power, transfer pricing, how internal units charge each other, and performance measurement systems.
Setting the rules of the game. The outline mentions ROI, RI, and EVA as performance measures. Chillax-Inn's example. Briefly, what are they?
They're common ways to measure the financial performance of investment centers. Return on investment, ROI, is basically operating profit divided by the assets used to generate a percentage return.
Profit relative to assets.
Residual income, RII, is operating profit minus a charge for the costs of the capital invested in the center. It's a dollar amount of profit above a required minimum return.
Profit above a hurdle rate.
Economic value added, EVA, is a specific, often trademarked version of RI that uses particular definitions for profit and capital, usually focusing on after-tax figures and the weighted average cost of capital. It aims to measure true economic profit creation. Figure 20-1 compares these for chillaxins.
Different ways to measure value creation from investments. And lastly, the importance of ethical considerations. Why is that crucial here?
Because management accounts deal with sensitive information, their work influences major decisions, and they have a responsibility to stakeholders. Integrity, objectivity, confidentiality, competence. These ethical standards are paramount. Trust in the numbers and the people producing them is fundamental to the whole system working.
Foundation of trust. Absolutely. Wow. Okay. That was definitely a deep dive. We've covered a massive amount of ground in management accounting, from basic costs right through to strategy and sustainability, all drawing from our source.
Yes, it's a broad field, but hopefully you can see how all these pieces fit together. They really form the financial intelligence system that helps an organization navigate, make smart choices, manage resources well, and ultimately achieve its goals.
It's clear they're all interconnected. And while we covered a lot, you get the sense you could spend weeks on each of these topics alone.
Oh, easily. Each one has layers of depth, which brings us to a final thought for you, the listener, to chew on.
Good.
Considering just how fast things change in business today, the dynamics, the competition, how could really mastering these management accounting principles give an organization a genuine, lasting competitive edge?
A powerful question indeed. How does this knowledge translate into sustainable advantage? Something to think about. We hope you'll consider which parts of this dive sparked your interest the most and maybe explore them further. Thank you for joining us.